Hello, everyone. Today on the final bar, we'll talk about a market bouncing strongly today with the S&P up almost 1.5%, closing around 4226. Nice bounce off the 50-day moving average for a number of stocks. A lot of charts that look pretty negative going into the close on Friday, starting to show some signs of life. The real question, I think, for a lot of investors, is this a short-term mean reversion, sort of regaining some of those losses from last week, or the beginning of a recovery? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. Happy Monday. This is your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the message of the markets. We focus on the charts, the message that is embedded in price and validated, confirmed by the measures of breadth and sentiment. Last week was certainly, I think, overall a statement of distribution, sort of disbelief on the Fed's ability to keep stock prices higher, speculation or anxiety about the future of inflation, of interest rates, Fed policy, et cetera, and overall weighed more on the downside for the broad equity markets. Today, certainly a reversion back to the upside. And here's the kicker. That sort of move after the distribution, especially in the cyclical sectors toward the end of last week, is totally normal, right? Actually, you have a big distribution day or a big distribution week. It's totally normal to have a bit of a bounce. And the challenge is, is this a trap, right? Something where it's just a little bit of a bounce and it's just enough to suck enough people in thinking they might have caught the bottom. And then what happens is when the downtrend resumes, everyone that tried to buy in on the dips out of the lows all of a sudden is underwater very quickly. And that's how a downtrend can perpetuate. It'll be interesting to see how the remainder of this week goes. On my own YouTube channel called Market Misbehavior, I posted a video last week talking about the 4 charts I have hanging in my office. And I'm reminded of the fact that if you are bearish on the markets, you are fighting 100 plus years of equity market history, if not more. You're fighting centuries of a growth story for equities, right? Overall, economies have been growing. Equity markets have appreciated. So it's okay to be bearish in the short term, but if you're bearish too long, you're fighting against the long-term trend of historical averages. We'll get to all of that and more here in our market recap. I did want to let you know some upcoming events. Tomorrow on June 22nd is our latest episode of The Pitch. This is our monthly show. We've done this a number of times before. We're going to be doing it every month now going forward, featuring 3 different strategists, all providing their top picks. We'll have 3 strategists, each giving you an opportunity to pitch 5 stock ideas. And then our moderator, and tomorrow will be Grayson Rose, will weigh the strengths and weaknesses of their comments and have a good discussion. You will leave with a list of tickers on a piece of paper to review for your own portfolio. Should be a lot of fun. Also on this show tomorrow, we have Julius DeKempener joining us from RRG Research. We're going to be looking at the RRG a little later in today's show. Always a pleasure to have Julius on. He designed the visualization and knows it better than anyone. Tony Dwyer from Canaccord Genuity is going to be joining us on Wednesday. And then on Thursday, we have Bruce Frazier from White Coffee and Bruce Frazier from Power Charting on StockCharts TV is going to be joining us. So on Monday, we're going to continue on here with our market recap. Monday, we hit the market from 3 directions. We'll talk with about the macro picture. We'll talk about sectors. Then we'll talk about stocks. And that process of going broad to specific, macro to micro, sort of mirrors my own weekly process of starting with the big picture on Thursday to Friday of every week, finishing with individual stocks on Sunday into Monday. And that's the way that I sort of cover all of the charts that are of interest and make sure that I know what's happening. So let's start with the big picture, talk about macro asset allocation right now. So today you had the S&P bouncing higher, up 1.4%. And again, this is coming off of a fairly weak performance stretch last week, and Wednesday, then Thursday into Friday really showed the weakness in stocks. Bouncing back up today, 1.4% positive. The NASDAQ 100 actually lagged behind, up 0.6%. Mid caps and small caps both up about 2.25%, outperforming the S&P. And the VIX, by the way, is back below 18 now. Other asset classes, very quickly, you have 10-year yields around 148. They've come off pretty good on Friday, but going back to the upside today, and higher yields certainly fueling strength in financials and the other cyclicals. Higher yields tends to be more value friendly than growth friendly. And so growth sectors tend to struggle today. Again, all up though, all 11 sectors were positive. But in general, value outperformed, and that's certainly part of the reason why. The TLT bond price is down 1 2/3%, so pushing lower after rallying on Friday, and the dollar down about 0.5%. This sort of strengthening dollar story has been a bit of a change, and that's what happened sort of last week. You had this bounce higher in the dollar, but weakening back today with the UUP back below 25. Commodities overall holding up very well. Energy prices moved higher today with the USO, which is what we usually use as a proxy for crude oil prices, up just over 2%. So energy, the number one sector in the S&P today. The GLD was up 1.2%, nearing 167. And we talked about the strength in commodities, the super cycle in commodities, which I think is we're in the midst of. We talked about the strength in precious metals, but last week, sort of giving a lot of that back. And toward the end of last week, you had gold selling off pretty good. Nice bounce back higher today. Cryptocurrencies overall, whoa, I jumped all around the platform there, sorry. Cryptocurrencies all very much in the red today. And a lot of the media requests we've been getting at StockCharts have been related to cryptocurrencies. Today you had Bitcoin down 8%, Ethereum down 13%, everything else down double digits in this 10 most liquid coins that we have featured on our dashboard. So overall, certainly some weakness there. We're going to look at a chart of Ethereum here in a minute and talk about what that represents. Let's start with the chart of the S&P here. We'll come back and talk about sectors and stocks here in a minute. So here's what the picture looks like on Friday. Here's what one day does to change potentially the character of the chart. On Friday, we saw the breakdown of trendline support. This is a trend line that has taken the October low, taken the March low, connects very nicely to the May low. And we've talked about that coming in play. We touched that on Wednesday's session. This was after the Fed meeting. Stocks came off and touched that trend line, traded below it, but closed back above it on Thursday, and then really followed through to the downside on Friday. And Friday's close was actually the first close below the 50-day moving average since back in early March, back here. So certainly indicating a change from uptrend to, at the very least, consolidation, breaking that trend line that we've talked about for a while, getting below the 50-day for the first time in quite a while. And we talked about testing that most recent swing low, which is the low right here coming from early June. As we've talked about many times, right? An uptrend is a pattern of higher highs and higher lows. A downtrend is a pattern of lower highs and lower lows. So it's easy. All you need to look for is the S&P starting to make lower lows and lower highs. That's what causes us to get way more cautious, like here in mid-May, when you see a rotation to below the most recent swing low. That's when the likelihood of going materially lower than current levels is certainly there. It's a non-zero risk that you're going to have quite a deep sell-off. And that's, for me, just tells me to get defensive and get cautious. What we're seeing here is a similar sort of pattern on Friday, but today bouncing right back above. So we did not get the follow through down through the 50-day moving average. We did not follow through with a break to a new swing low, breaking below that June low. So at this point, sort of the real negative sign is alleviated until we get below there. And I think that's why tomorrow is so key. After a breakdown like we saw on Friday, a bounce higher, which a lot of times you could call a dead cat bounce, which is basically a big move lower, and then you bounce up just a little bit, enough to get a lot of people drawn in. If this really is a bear market phase, you'll see some distribution, most likely starting tomorrow or at the very latest later this week, to follow through on that breakdown that we saw through the 50-day moving average. If not, though, this could certainly be a bounce higher and a move to new highs. We've seen that many, many times in the past year, especially in the last 6 months. How many times have we seen a pullback to the 50-day and then it turns right on a dime and goes back to the upside? We could be facing that again. The charts are going to tell us what to be thinking about those things. Last thing I want to show, we'll talk about Ethereum in a little bit. I did want to hit up the chart of Bitcoin only because they're at pretty key moments here. We've talked on this show and on my YouTube channel, recorded a video a couple of weeks ago talking about the overall structure of Bitcoin. And you had this, accumulation phase up until the peak in April. We then distributed, clear pattern now of lower highs, lower lows. I think by default, the path of least resistance is down until proven otherwise. The big red arrow at the bottom shows you my main concern, which is the lessening of momentum from January, year to date, every next major high every month when Bitcoin has made a high of some sort, the momentum has been lower than the previous month. That is not what sustained bull moves are made of. That's what a downtrend is made of, right? An inability to increase momentum, an inability to draw buying power into the market and push demand higher, push prices higher. So at this point, you're sort of range bound between 31,000, we'll call it here, 3031 on the bottom, and 4142, we'll call it here at the top, which would be the peaks from the last month or two, and also the 200-day moving average, Fibonacci resistance, all around that same point. I think we're right there. We also have a declining 50-day moving average right around 42,000 as well. So if we would bounce, I think that's significant resistance we've been unable to break above. My concern is, what if we break below 30,000? That would take us through the final Fibonacci support level. That would take us through the May lows. And I think you could see a quite an acceleration of selling pressure if you start breaking down through a key support level there, because it tells you as Bitcoin is no longer in the 30,000 range. It's now back in the 20s for the first time since really last December, which is very much a change of character for an asset that felt like it was going to go to 100,000 plus in the near future, right? So that is certainly a chart to be paying attention to. Given the weakness that you saw in cryptocurrencies today, I would be watching some of those support levels, which I think are very much in focus this week. That is our market recap today. Our next segment is called Sector Setup. So we talked about the big picture. Now let's talk about the 11 S&P sectors and what's what there. Today, as I mentioned earlier in the recap, cyclical sectors led with energy up 4.3%, financials 2.3%, industrials and materials also up more than 2%, and real estate not far behind. So this is certainly a cyclical led bounce today, and very much a mean reversion after these sectors really got hit last week around the Fed meeting. On the downside today, you had the three worst performing sectors, which all noted were positive on the day, but have underperformed: consumer discretionary, communication services, and technology. Let's look at the 11 sectors using the RRG visualization. As I mentioned, Julius de Kempener is going to be coming on our show tomorrow. So if you're familiar with this, or you want to learn more about it, if you want to understand more from the man who created it, join us on the show tomorrow. It's always fun to have Julius share some of his expertise. But, you know, looking at the weekly RRG, which is the long-term view, you can see how energy has rotated higher. So days like this certainly helping to push energy back into the leading quadrant, or toward the leading quadrant. The number one sector on the weekly routine is real estate. And we talk about the real estate sector. We talked about the strength in charts like SPG, which we'll try to get to here in a few moments. So in terms of the strongest out of the 11, real estate is it. The two others that I would mention that are worth noting, one would be healthcare. Healthcare is sort of sneaky over here in the improving quadrant. The reason why healthcare is not up here is because some of the largest stocks are the ones that are not leading the way higher. The really interesting charts are in things like equipment and medical supplies, which are some of the smaller groups. Still plenty of market cap there, but not as big as some of the big pharma names or others that would that dwarf some of the others. So if you take those out of the equation, you look at some of those charts, I think XLB would be in a much stronger case. So within healthcare, there's potentially some good opportunities there. Communication services is also another one. This is heading in the right direction, heading northeast, nearing the leading quadrant, so worth paying attention to. Let's look at the 11 S&P sectors using the candle glance function. So this is, I always relate this back to when we would print out a bunch of charts, put them on a big table, and start to pile them, put them in piles based on relative strength or weakness, looking for breakouts, breakdowns, actionable turns, and just sorting the charts that way. The candle glance function allows you to do that with a group of charts, and can always be helpful as a way to make sense of a group of things. And I encourage you, by the way, if you don't look at your own portfolio, your own holdings, your own watch list using this, I think you're missing a really good opportunity to do like a visual pattern scan, right? Out of these charts that you're owning, which ones are breaking down through an ascending 50-day moving average? I would be keenly interested in that and be focusing on defining your risk awareness, defining your risk assessment on a chart like that. So what stands out as we're looking at the 11 S&P sectors? So first off, I'm struck by some of these sectors that have already broken down through their 50-day moving average, and 3-4 sort of jump out at me. Number one would be consumer staples, recently through their 50-day, the financial sector, materials, and you can see utilities over here. Let's look at the materials sector just as an example of that. So this is a sector that has been in a really good stretch of performance, the relative strength making a new high here in May, the sector ETF, the XLB making a new all-time high there in May. of 2021. You can see it's given back a pretty decent amount. It's about a 10% drop from where we were here, a little under that, right? Maybe 9% or so from the peak that we saw there in May, and then a couple lower peaks. And then we rotated lower and we've dropped down to just above $80 share, and I'm back up to about 82. So the problem when something's broken its 50-day is then where do you define the next level of support? This is an area where it could be really helpful to draw Fibonacci retracements. With a lot of these, the problem is if you take the low in March of 2020 and connect it to the high in May, there's going to be a lot of daylight before you hit the first Fibonacci level. And that's what I'll show you here. If you take the low here in March and you connect it to there, you're not even hitting the first Fibonacci level, so you're down here below 70, which is another, 10 to 12 points below where we're at right now. That's a pretty significant drop to get down to those lows. So it might be helpful to actually look at a shorter term time frame and zoom in a little bit on the last 6 months and focus on some of the short term support levels. What I would note on this chart, and we're going to switch to this one just to show the RSI. What's worth noting on some of these sectors that have broken down through the 50-day, they're all oversold. And that can mean a couple different things. Number one, this could be the beginning of a bearish phase where the whole range on the RSI goes lower. But it also can be a good indication of mean reversion. You can see here the RSI becoming oversold, coming out of that oversold region, and the sector bouncing up just a little bit. And I'll be looking at some of these other sectors as well. They all have a very similar pattern where you've sold off enough, you've become oversold, right? And so the question is, how much do you bounce from here? I think what I would suggest is taking the distribution that you saw last week, how it accelerated to the downside, especially in financials Thursday into Friday. That low around 35 on the XLF would be a level I would pay attention to. If that's able to hold this week, this could be beginning to build some upside momentum, at least, drying up the distribution pressure that we've seen last week. Maybe that's enough, but I think you break 35 and that just indicates that we're in more of a bearish trend. And my concern is on charts like this. I think now that you've broken down through the 50-day, you've broken down through the recent swing lows. For me, I tend to think the path of least resistance is down until proven otherwise. I'd want to see some accumulation, especially a higher low, an indication that buyers are coming in and buoying the price higher out of a weak level. In terms of things that are interesting before we wrap here for the commercial, the energy sector bouncing off of its 50-day moving average, the healthcare sector bouncing off of its 50-day moving average and moving higher. Those are sectors where I might be looking for opportunities to see if you can ride the next leg higher. We need to take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the markets together, focusing on the charts themselves. As a reminder, we'll do another mailbag segment on Tuesday's show. We would love to hear from you and answer one of your questions on the air. Our email is thefinalbar@StockCharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Just go to the YouTube Stock Charts channel, put a comment below the video that you're watching. We'll gather all those questions. Nothing is out of bounds. Ask us about market history, about particular charts or tickers, technical indicators, behavioral biases, whatever comes to mind. We'll do our best to point you in the right direction. Email is the best way to get us, thefinalbar@StockCharts.com. Also, as a reminder, the new Stock Charts TV on demand is out. It's available. It is beautifully designed, and we're super proud of the way you're able to consume content on that website, StockChartsTV.com. We're also on all the app stores. You can use your email, set up a free account, start watching all our content immediately. Just on the app store, search for Stock Charts TV on demand. Our next segment today is called Shifting Stocks. So what we like to do, third part piece of the puzzle, we talked about the macro big picture, with the S&P bouncing after really breaking down on at the end of last week, really bouncing out of that. And the question is this a dead cat bounce, a short-term rally before we resume the downtrend, a very expected mean reversion after a breakdown, or is this the bounce similar to previous bounces that we've had? I think the jury's still out, to be honest with you, based on the weight of the evidence. Most charts bounced very nicely today. A lot of the cyclical stocks that we've been talking about bounced very well. We'll look at a chart of Marathon Oil here, MRO. Now, this is what a lot of energy stocks look like. And, in a vacuum, I always like to think if I just saw this chart out of nowhere, I didn't know anything else about what was happening on the macro perspective, nothing about interest rates or inflation or whatever. I'm just looking at the chart. Overall, this seems like a pretty decent chart to me. This seems on the bounce that you're having today, this is a chart making higher highs with the June high eclipsing the March high. It's making higher lows, bottomed around 1250 and bouncing up to the upside today, above two upward sloping moving averages. In general, in a vacuum, that's the type of chart I probably feel pretty good about owning. Those are the charts that tend to make sense, right? Stocks in good uptrends and cyclical uptrends, making new swing highs. I had a bit of a basing pattern there in the last 3 months, but resolving that to the upside, breaking to new highs, and now potentially bouncing higher. As with anything, it's all about measuring your risk and thinking about the upside reward. This breakout that we've seen recently gets it above the highs that you saw at the beginning of 2020, even before that in 2019. So overall, I think that's a chart that sets up pretty well. A lot of the energy stocks, by the way, we don't have to look at all of them, but FANG is another one, making new swing highs today. It's even more encouraging than MRO, I would argue, because this is a resistance level here in March and in May, breaking above that, testing that, now pulling back to 85 and now rotating back to the upside. In general, I don't have a problem with assuming that the trend there is positive until proven otherwise, until the signal is down. The top 10 scooter ranked stocks in the large cap space, a lot of energy and related cyclical sectors right now. What else can we talk about? We've been talking about, and I have a list of tickers here on paper. My process is pretty old school. I look at a lot of electronic charts, obviously, but I jot things down in a paper notebook every Sunday into Monday. It's kind of what I've been doing for a while. So I'm trying to pick things that I think would be actionable. We've talked about real estate for a while, and I love highlighting a year like 2014. And if you go back, you'll find that in a cyclical bull market within a secular bull market, when everything's working, it feels like, and if you think back, what sectors were probably working in 2014, I would guess technology, which is wrong. I would guess consumer discretionary, which is wrong. I might guess industrials or materials or energy or healthcare, and all of those are also wrong. The top two sectors were utilities and real estate. Boring, defensive, not offense, but very much defense. Utilities and real estate, but based on the combination of factors there, those are the top sectors. And, not just on a capital appreciation basis, but it's a total return picture, including dividends, is where you really had pretty decent return. So a year like this, where real estate is doing particularly well and it's outperforming and the trend is positive, I learned a long time ago not to be surprised by that, but just to embrace it. That's why I think systematic momentum models just driven on price will point you to things like real estate that you would not expect REITs to be doing well right now, but they are. And when I'm looking at the chart of SPG, which is one of the larger REITs that we would track, about a 43 billion market cap, nice bounce off of the 50-day moving average. Like many other tradable bounces within this uptrend, really broke out to the upside in November of last year, got above the 200-day moving average, above the 50-day, and hasn't looked back. And again, that's a chart that certainly seems to be setting up very, very well. It's a decent pullback within an uptrend. So again, a lot of charts here, while certain things have broken down, while things like the S&P really broke down on Friday, which caused me to think much more defensively, I'm drawn to charts like SPG, which have not broken down yet and are still in pretty good shape. So there are plenty of stocks that have not broken their 50-day moving average yet. Those may be good opportunities to lean into leadership that may continue. Biotechs come to mind as well, as I was reviewing a lot of the charts, setting up pretty well. Within biotech, you actually have quite a differentiation. It's not all one stock. And so I hesitate to look at something like IBB because it's not totally homogenous. There's some very different charts in that group if you look at them. And by the way, if you're thinking of a group like biotech and you're wondering what are the charts within that group, best way to do it on StockCharts, just to digress for a moment, go to charts and tools, go to the industry summary page. I like to look at the table view because I'd much rather look at this in a tabular format. Go down to healthcare, you'll find biotechs listed out. This lists out all the biotechs that we have in our equity database. You can sort them by percent change. You can sort them by scooter ranking, which I often find helpful because then you'll see the strongest trends down to the weakest trends. You can also sort it by market cap, which is that column that says U, which stands for universe, and you can see which what the largest stocks are doing versus the smallest. That is a great way to sort of focus on some of the leadership there. And Biogen, by the way, which is a big stock, had the big move higher in recent weeks, is sort of causing a lot of that group as a whole to look pretty good. But you can see overall there are a lot of pretty strongly ranked stocks within that group, by the way. Sorry for digressing. I just wanted to share that about the industry summary. So the IBB setting up pretty well, right? I think the kicker is getting above these March and April highs. We did that, pulled back a little bit, and now we're right back up to that same level. I think this is a really key chart to watch right now. Do we resolve higher? Which certainly the higher low we saw last week, I think, suggests that that's certainly what we're setting up to do, aiming toward previous highs. What's the downside risk? I'd be looking at the 200-day moving average. I'd also be looking at these lows here, February, March, April, May, sort of all had, March, April, May, all had lows around that 145 level. That seems like a good, potential area of support, but overall appearing to set up pretty well. Let's see what else. We have a couple names reporting earnings this week, which might be good to pay attention to. I'll just say we have a minute, so I just want to highlight very quickly. Nike is one. This is a stock, obviously, that's come down below long-term moving averages, really testing support around 125, which are the lows from March and April. My question is that able to hold yet a nice, close higher and then continuing on to rally today. But overall, I still think that's a questionable trend with pretty good resistance above where we're at. It's really been more of a range-bound story. FedEx is another one. If FedEx and UPS tend to be interesting bellwether themes, right? Are these shipping companies holding up right now? I think it's right at a key point, right? As the RSI is just below 40, which is sort of where you'd expect it to bottom if all is well. But going into the weekend, when I was reviewing these over the weekend, boy, it certainly looked like it was following through to the downside. I'm looking at the 200-day. I'm looking at the lows here from the first quarter, bouncing today, but overall, that's what I would be looking to see if those are able to hold. And then PAYX, I think that's on Friday morning before the open. Talk about a good long-term trend. A strong stock with a strong trend above the moving averages. An earnings release that disappoints has an opportunity to completely rupture a really decent chart. But overall, I would assume that the path of least resistance is higher on a chart like that until proven otherwise. Notice, by the way, on the RSI, has just remained almost above 50 for the entirety of the last 4 or 5 months, which is a pretty impressive long-term trend. That's all we have time for shifting stocks. We need to wrap the show. Go to the 3 in 3 charts in 3 minutes. Here we go. Chart number 1 is Ethereum. We talked about Bitcoin a little earlier, and I mentioned all the cryptos are really distributing here. I hope you're not surprised by that. We've talked about how I think the path of least resistance is lower, and that's driven by the fact that overall you've just seen clear patterns of distribution. When you look at the chart of Bitcoin earlier, we saw how every new high, every monthly high in 2021 has been met by lower momentum, right? The RSI has been getting lower and lower. Ethereum, not the case, and you saw it accelerated to the upside in May, made a new high with its RSI, strong upside momentum, which is why the Ethereum to Bitcoin ratio so strongly has favored Ethereum. But even coins like this are feeling some weakness. Bounced off of around 1650 or so here. This was maybe 1700. Last end of last month in May, bounced back up to the 50-day moving average, testing that from below and now rotating lower. You have the 61.8% retracement level just above 1700. That lines up almost perfectly with the May low. That is the line. We're testing the 200-day and we're testing that support. If those hold, you have experienced an actionable low within this period. But overall, I would not be surprised if those levels break. I would not be surprised if this gets lower than that. And then the question is, where are you aiming below that? I'd be looking for deeper pullback levels. Biotechs, I mentioned in our shifting stocks segment. Overall, I think it's right at a key level, right at this pink line, which is lining up the March and April highs. I think there's upside to this February high, and I think your stop on that sort of thing for me would be down here around 145. That's the high from last July, the high from last October. You can see the market has memory. That level has been important here so far in 2021. I would be looking there on any pullback. Finally, look, there are charts like IBM that are bouncing right off of their 50-day, just as they should if all is well. So overall, stocks like this hold their ascending 50-day moving average. Things are not that bad. Stocks like IBM break their 50-day through the course of this week, and a series of charts, a market that has looked okay, could start to look less okay. Folks, that's our show for today. Thanks for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.